Recently, one of the hottest economic indicator is the Consumer Price Index, and it has been one of the major market movers. But what exactly does it tell us? Released once a month, it measures the average change in prices of a basket of goods and services consumed by consumers, providing insight into inflation and the cost of living. It is widely followed by economists, investors, and policymakers and can have a significant impact on the financial markets. In this video, we will delve into the origin, the calculation, and the key numbers of the CPI report and explain how this data is relevant to you as a trader or investor. We'll also explore how traders and investors use the information from the CPI to make their investment decisions. As you can see, I provided an infographic here, which you can check out in the blog post in the link below. First, what is the CPI and its origin? The Consumer Price Index is a measure of the average change over time in the prices paid by consumers for a basket of goods and services. It is used to calculate the inflation rate, which is the rate at which the general level of prices for goods and services is rising and thus purchasing power is falling. The CPI is used by governments, central banks, and economists to make informed decisions. The origin of the Consumer Price Index can be traced back to the late 19th century when the US Bureau of Labor Statistics, or the BLS, began collecting data on the prices of goods and services. The BLS was officially tasked with calculating the CPI in 1918, and the first official US CPI was published in 1919. Today, the CPI is used in many countries as a measure of inflation and is widely used as an indicator of changes in the purchasing power and the cost of living. So how is this CPI data calculated? The CPI is calculated using a statistical survey that collects data on the prices of a representative basket of goods and services purchased by consumers. The basket of goods and services is based on the expenditure of a typical consumer and is designed to represent the purchasing patterns of the general public. The prices of the goods and services in the basket are collected at regular intervals, which can be monthly or quarterly, from a sample of retail outlets, service providers, and rental markets. So this data collected is used to calculate the average change in prices for these goods and services over time. And the average change is then used to calculate the inflation rate, which is the percentage change in the CPI over a specific time period. So the inflation rate provides an indication of how much the cost of living has increased and how much the purchasing power of consumers has declined. So the calculation of the CPI involves several steps. First, the selection of goods and services, right? So you need to select that basket of goods and services that is a representative of, the typical consumer. And then the next step is the collection of the price data, right? So after you decide on the basket of goods, you need to collect the data, right, at regular intervals. And then lastly, you need to weigh the prices. So this is a bit of like an adjustment, right? And it's based on data and consumer expenditure. And then next you do a calculation of these average prices. And lastly, using this average price, you will calculate the inflation rate, right? So as I said, it is the percentage change in the average price of the basket over a specific period of time. So note that the CPI is just one many measures of inflation, and there are other methods of calculating inflation, such as the Producer Price Index, the PPI, or the GDP deflator. So what are the key numbers that you get from this CPI report? So some of the key numbers include firstly, the overall Consumer Price Index, or overall CPI. So this is the most widely used and well-known number from the CPI report, which measures the average change over time in that basket of goods or services, right, which we just talked about. And the next is the core CPI, right? So this core CPI excludes volatile food and energy prices, so it provides a more accurate measure of the underlying inflation trends in the economy. The next important piece of data is the inflation rate. So this is the percentage change, right, of the CPI index over time. And then you have some other indices, right, which is more of like a breakdown of the CPI, right, including like the food and beverage index, right. So this measures the change over time in the prices of food and beverages. And then you have the energy index, the housing index, the transportation index, the medical care index, and the apparel index, right. So all these different indices measure a specific segment within the bigger CPI. So this information can be used by governments, central banks, economists, and businesses to make informed decisions about monetary and fiscal policy, as well as to analyze economic trends and conditions. So how is this data relevant to traders and investors? It is important because inflation has a significant impact on the financial markets. Inflation affects the purchasing power of consumers and the value of money, and can have a direct impact on the demand of the goods and services, as well as the supply of goods and services. A more direct impact on the financial markets would be because central banks often use monetary tools such as adjusting interest rates to control inflation, and this does affect the market. For example, if inflation is rising too quickly, central banks may raise the interest rates to curb inflation, which then leads to a decrease in consumer spending and economic growth, which has a negative impact on the financial markets. Conversely, if inflation is too low, central banks may lower interest rates to encourage consumer spending and economic growth, which can have a positive impact on the financial markets. So traders and investors use the consumer price index as well as other inflation measures to make informed investment decisions, such as determining the expected direction of interest rates and adjusting their portfolios accordingly. They also use the inflation data to make predictions about the future direction of the financial markets, such as stock markets and bond markets, and to make decisions about the timing and the size of their trades. So this consumer price index provides valuable information on the level of inflation in an economy, and is an important tool for traders and investors to monitor, to analyze these economic trends and conditions so that they will not be caught off guard. Lastly, how do traders, right, actually use this CPI data if they want to do some news trading? Traders may use the overall and core CPIs to gauge the level of inflation in an economy and to make predictions about the future directions of interest rates. So for example, if the overall CPI or core CPI is rising rapidly, then it may signal that inflation is becoming a concern, right? For example, what we saw the last few months, right? And traders may expect the central bank to raise interest rates, which then has a negative impact on the financial markets, which is what we have been seeing the last few weeks. If the overall CPI or core CPI is rising rapidly, it may signal that inflation is becoming a concern, and traders may expect the central bank to raise interest rates, which can have a negative impact on the financial markets, which is what we are seeing now. On the other hand, if the overall or core CPI is low or declining, traders may then expect the central bank to keep interest rates low, which will have a positive impact on the financial markets. Next is the inflation rate. So traders may use the inflation rate to assess the pace of inflation and to make predictions about future inflation trends. So the first point was about the actual inflation itself, whereas the inflation rate is the pace, right, that the inflation is increasing. If the inflation rate is high, it may signal that inflation is becoming a concern, and traders may expect the central bank to raise rates, which will then have a negative impact on the market. On the other hand, if the inflation rate is low or declining, traders may expect the central bank to keep interest rates low, right, or even cut interest rates, which will then have a positive impact on the financial markets. So these data points from the Consumer Price Index report may provide valuable information on the level of inflation in an economy and its components. And traders use this information to make informed trading decisions, such as adjusting their portfolio. For example, if certain sectors are increasing or inflating faster, right, then traders or investors may want to rebalance in their portfolio based on which sectors are having a more positive or negative catalyst, right, in inflation. So here are my concluding thoughts. In summary, the consumer price index is a critical measure of inflation that can have a significant impact on the financial markets. As a new trader or investor, understanding the origin, calculation, and key numbers of the consumer price index report is crucial in making informed decisions. The data provides insights into inflation, purchasing power, and economic trends, which can help you navigate the financial market and make sound investment decisions. Now that I've covered all about the importance of the CPI report, is it something that you will add to your trading portfolio? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe and hit the bell notification icon to receive the latest updates. That's it for this video, and I'll see you in the next one.